Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. In this episode, we discuss the outlook for equities as an asset class. Coming into this year, we made three broad points regarding the equity outlook. First, after having contracted significantly in 2021, we expected the valuation multiples to fall further this year. Second, we saw upside to the 2022 corporate earnings growth estimates, which stood at circa 7% at the start of the year. Third, we said that driven by the conduct of the monetary policy in the US, valuation changes are likely to induce volatility and influence the returns during 2022. All these three did indeed materialize. As at end of September, equity valuation multiples have contracted significantly, solely contributing to the decline in equity prices this year. Consensus corporate earnings growth expectations for MSCI All Country World Index during 2022 moved higher to 8.5% now from just under 7% at the start of the year. While we were expecting a contraction in valuation multiples, we did not foresee a contraction of this magnitude. As inflation proved persistent, Fed indicated its strong resolve to fight inflation with tighter monetary policy. No surprise, Fed officials invoked the memories of the Volcker-era Fed, and equity markets responded equally aggressively. To put things into context, during the late 1970s, Fed raised interest rates sharply from 4.75% in 1977 to 16% in 1980. Equity market valuations, as measured by the trailing 12-month price earnings multiple of S&P 500, shrunk by 37% over the same period. Fast forward to the present, equity valuations corrected by 33% already this year as US policy interest rates rose around 3 percentage points. Looking ahead, given the extent of derating that happened already, valuation compression might not have much further to go. As such, the 12-month forward price earnings multiple for global equities has fallen sharply already and is now below the 20-year average of 15.3 times. Yet, much of this compression in valuations or the expansion in earnings yield was driven by the rise in risk-free rate, while the equity risk premium, that is the premium demanded by investors to hold equity risk, has not changed much. With the risk-free rates already pricing in the rise in policy rates, we believe that we are close to the peak of the cycle. If anything, risk-free rates should fall in case a global recession materializes. However, in that scenario, the ERP, equity risk premium, is likely to rise, making it a bear case. The extent of rise in ERP will depend on how deep and prolonged the recession is likely to be. In case of a mild recession, ERP rise is likely to just offset a fall in the risk-free rate, allowing the valuation multiples to remain unchanged at the current below average levels. In case of a deeper recession, which is still unlikely in our view, ERP could rise sharply, more than offsetting the favorable movement in risk-free rates. Our base case still sees a soft landing where risk-free rates and ERP remain stable. Yet, our bull case scenario with low probability sees a sharp fall in risk-free rates as central banks pivot and ERP remains stable, providing scope for valuations to expand at least marginally from current levels. Remarkably stable equity risk premium was underpinned by strong earnings growth for the corporate sector. Despite the calls for earnings to fall off the cliff in Q2, corporate earnings reported better than expected earnings. While we see earnings growth normalizing from elevated levels, we do not see an earnings recession in our base case. Of course, should an economic recession materialize, earnings are likely to fall sharply, adding to the downside described in our bear case scenario. However, in case our thesis of a mid-cycle slowdown and not a recession materializes, earnings growth can accelerate in the second half of 2023 as economic momentum strengthens. Equity sentiment is already weak, positioning is cautious, valuations are now more normal, and the recent performance is already reflecting a tighter monetary policy. In case the inflation cools rapidly and central banks do pivot, both paving way for soft landing of the economy, equity market returns could be strong over the next 12 months. Yet in the near term, against the backdrop of elevated uncertainty, equity investors are better served by remaining defensive and by focusing more on quality and non-cyclical growth. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com for more information. My name is Kishore Muktinutalapati, and I'll be back next week with another episode of Global Investment Insights.